The ticker is flashing in the mid-$2 zone, a microscopic blip on the broad market radar that most institutional portfolio managers wouldn't spot with a high-powered telescope. Walk onto any mainstream financial television network or scroll through the endless echo chambers of retail trading forums, and Xos, trading under the ticker symbol XOS on the NASDAQ, is either completely ignored or lazily lumped into the graveyard of overhyped post-SPAC electric vehicle failures. The consensus narrative is simple, brutal, and entirely surface level. High interest rates have killed the green transition, cash-burning truck startups are going bankrupt, and commercial fleet electrification is a pipe dream that collided with macroeconomic reality. But beneath that lazy headline consensus lies a stark, structural operational shift that the market is mispricing with astonishing blindness. While retail investors chase high beta momentum stocks and institutional algorithms screen out anything under $1 billion market capitalization, Xos has quietly transitioned from a speculative design stage concept into a high-margin, purpose-built commercial vehicle and energy solutions provider that is solving the single biggest bottleneck facing modern commercial logistics: the grid infrastructure wall. Look past the distorted macro noise and you uncover a fundamental physics and logistical bottleneck that traditional automakers and legacy fleet operators are scrambling to navigate. When a major logistics giant or parcel delivery network attempts to electrify its last-mile fleet, they run headfirst into a brutal reality. Local utility grids cannot handle the simultaneous high-voltage draw of 100 commercial delivery trucks plugging in overnight at a single depot. Upgrading transformer capacity and waiting for municipal utility interconnects can take years and cost millions of dollars per depot, creating an invisible ceiling for fleet electrification that no amount of vehicle manufacturing can bypass. This is where the standard financial media completely misses the strategic genius of what Xos has built. They are not merely an electric truck manufacturer trying to beat legacy internal combustion engines on a pure vehicle purchase price. They are an integrated fleet electrification architecture company. By coupling their proprietary Class 5 through 8 commercial step vans and chassis cabs with the Xos Hub, a mobile, battery-integrated DC fast charging and energy storage infrastructure system, they have engineered an end-to-end workaround for the grid bottleneck. Fleets can deploy electric vehicles today, bypass multi-year utility upgrade queues, and even monetize their stored energy by feeding power back to the grid during peak demand events through virtual power plant integrations. Yet the public market continues to price Xos as if it were burning cash building passenger cars for fickle consumers, completely blind to the high-margin B2B reality of back-to-base commercial routing. When you pull back the curtain on the daily trading dynamics of Xos, you witness a masterclass in micro-cap market mechanics, where low daily trading volumes and structural illiquidity create wild sentiment swings that shake out retail investors on a regular basis. Institutional heavyweights and smart money micro-cap specialists do not buy a stock like Xos with massive market order splashes. They accumulate quietly during periods of low-volume consolidation, letting retail impatience do the dirty work. Every time macro jitters hit the small-cap clean tech sector, algorithmic selling programs trigger cascading stop losses among retail traders who bought the stock based on a viral forum post, driving the share price down and allowing institutional accumulators to sweep up high-value shares at pennies on the dollar. The daily volume profile reveals a classic accumulation footprint: tight consolidation ranges punctuated by sharp, low-volume drifts downward, followed by sudden, aggressive blocks of buying volume that absorb available liquidity whenever positive operational milestones are approached. It is a slow, psychological grind designed to exhaust weak hands before the structural inflection point becomes entirely impossible for Wall Street to ignore. Before we break down the operational engineering and the financial transformation hiding inside their balance sheet, let me ask you directly: Are you currently holding shares of microcap turnaround plays like Xos through the volatility, or are you sitting on the sidelines waiting for clear institutional confirmation before taking a position? To truly understand why Xos is structurally mispriced, you have to strip away the outdated historical framing of the electric vehicle boom and examine the hard operational economics of their business model. For years, the market viewed every EV startup through the distorted lens of consumer-facing hype, companies promising millions of futuristic passenger cars with zero manufacturing experience, zero service networks, and astronomical cash burn rates. Xos operates in a completely different financial and operational universe. Founded in 2016 and headquartered in Los Angeles, the company deliberately bypassed the consumer market to target the most predictable, high-utilization segment of the global economy, commercial fleet operators running predictable back-to-base routes of under 200 miles per day. Think about the trucks operated by household names like UPS, FedEx ground operators, and specialized armored transport leaders like Loomis. These vehicles leave the depot in the morning, execute a fixed delivery route, and return to the exact same depot every single night. They do not need a nationwide network of unverified public fast chargers. They need rugged, purpose-built electric step vans and chassis cabs like the Xos MDXT and the Xos Step Van that can be charged overnight at a centralized hub. This commercial focus fundamentally changes the total cost of ownership equation, which is the holy grail of B2B fleet management. Fleet managers don't care about political narratives or green subsidies. They care exclusively about per-mile operating costs, maintenance downtime, and vehicle uptime. Commercial delivery trucks running on internal combustion engines suffer from relentless wear and tear on complex transmissions, exhaust systems, and diesel particulate filters, leading to staggering maintenance overhead and frequent fleet downtime. Xos designed its proprietary X-platform architecture from the ground up specifically for medium and heavy-duty commercial applications, utilizing a simplified powertrain with a fraction of the moving parts found in traditional fossil fuel vehicles. Furthermore, the company integrated its own proprietary vehicle control systems, powertrain controls, and telematics systems into the chassis, giving fleet operators real-time diagnostic visibility and predictive maintenance tracking that slashes total lifetime operating costs. But the masterstroke of their operational model is the diversification into energy infrastructure through Xos Energy Solutions. By developing mobile charging infrastructure and energy storage products like the Xos Hub, the company transformed itself from a pure-play vehicle manufacturer into an indispensable energy transition partner. When Xos delivers a fleet of electric step vans, they are often also selling or deploying the charging infrastructure required to power them, creating a dual revenue engine where vehicle sales pull through high-margin energy storage and infrastructure services. The financial reality of this operational shift is beginning to shock the few analysts who bother to look past the market cap. In their financial disclosures, Xos demonstrated a dramatic inflection in operational efficiency and margin expansion. Delivering record revenue growth alongside a substantial surge in unit deliveries, the company proved that its manufacturing lines are scaling efficiently while operating expenses contract due to rigorous cost discipline. Most importantly, the inclusion of high-margin Xos Hub products and energy solutions has driven GAAP gross margins to levels that leave traditional automotive manufacturers and legacy commercial truck makers in the dust. Operating losses have hit multi-year lows, showcasing a clear, visible pathway towards sustainable cash flow positivity that flies directly in the face of the generalized market assumption that all EV-adjacent companies are burning cash into oblivion. Management is not sitting still, with upcoming strategic expansions into European markets and forward-thinking white papers detailing power infrastructure requirements for massive global events like the upcoming 2028 Olympic Games. Xos is positioning itself as an intellectual and technological gatekeeper in commercial fleet energy management. Looking toward the multi-year horizon, the growth catalysts lining up for Xos are staggering, though they exist alongside very real operational and macroeconomic risks that every serious investor must weigh. On the catalyst side, regulatory tailwinds for commercial fleet decarbonization are only tightening across North America and Europe. Municipalities and state governments are implementing aggressive zero-emission mandates for commercial delivery fleets, forcing major logistics providers to accelerate their electrification timelines whether they want to or not. Because Xos has already established trusted, validated vendor relationships with Tier 1 delivery giants and secured eligibility for lucrative state-level voucher and incentive programs such as California's Hybrid and Zero-Emission Truck and Bus Voucher Incentive Project Program, they are uniquely positioned to capture an outsized share of mandatory fleet turnover. Moreover, their partnership with virtual power plant platforms like Leap allows their fleet customers to participate in grid support programs, turning commercial charging depots into a cost center into a revenue-generating asset.